Yes, it's a long-term investment. I apologize for the brain seizure. Okay, so what I'm getting at is there are exceptions to when you will record an asset or carry an asset at its historical cost. If the value of that asset has depreciated, if it's your merchandise and it's depreciated, you've got to carry it at the lower of cost or market. In this case, it would be the market value. And the same is true when you purchase something. If you pay more for something than the market says, again, you're not going to carry that asset on the books at which you actually paid. You're going to carry it at the market value, and then you're going to debit an account called goodwill. Goodwill, just going off on a tangent here, if you're ever looking through financial statements and you're looking at a company's balance sheet and you see a goodwill account, get nervous. Goodwill is often an account that is used to mask some unethical activities, usually bribery. First of all, when you think about it, goodwill involves paying more for an asset than the market value. Okay? Why would you do that? Why would anybody pay more for an asset that they absolutely have to? Why would someone go and buy a gallon of gasoline for $1.50 that's priced at $1.50 but give the attendant $2? It's just not done. It's not done if you want to stay in business for very long. Now, from a personal experience, I had a family member who was working for a very large international corporation that had offices in Washington, D.C. And it's one of these K Street lobbying firms that kind of operates on the fringe and in the gray areas. It's always kind of in the shadows. Huge, monolithic international corporation, but when you read the prospectus, you can't ascertain with any degree of certainty what products it produces or services it provides. Now, and in fact, when you read the prospectus reads like some hodgepodge collection of terms and phrases that were just indiscriminately lifted from, the pages of Forbes magazine or the Wall Street Journal. They talk about synergies and economies of scale and empowerment and diversification, but they don't tell you what they're really doing. They don't tell you what products they produce or services they provide. And when I was flipping through the balance sheet, I saw that they had a $600 million balance on the goodwill account. And so I happened to, not that long after, I was at a party and I met one of the vice presidents, and I said, "What did you spend $600 million more on than the market deemed was its value?" And just dead silent. I mean, that killed the conversation right there. I was like, okay, there's something shady going on there. Now, this is my theory. That company was involved in energy exploration, and they explored some really far-flung, distant places, Kazakhstan, and just some places where the rule of law isn't even a consideration. And so what I think is that was bribery money. Conceivably, the company needed to have some licensing agreements signed by an interior minister. The interior minister wanted his pocket lined. That was withholding his signature, his authorization. But maybe the interior minister had a brother-in-law who was selling, a hectare of land, and the market value was like maybe $100,000, but they wanted $2 million for it. So what the company would do is it would debit land for $100,000. It would debit goodwill for $1.9 million, and it would credit cash for $2 million. And that's how you wind up bribing officials, local officials. Just throwing that out there. Okay, another principle that we want to concern ourselves with is something called the matching principle. Now, the matching principle says that you've got to match your expenses to the time periods in which those expenses generated revenues. We've talked about the insurance scenario where at the beginning of the year I sign a check for $12,000. Okay, so I debit something called prepaid expense, prepaid insurance for $12,000, which is an asset. Okay, it's a prepaid expense. It's called prepaid insurance. It's an asset, and I credit cash for $12,000. And then at the end of every month, I debit a little bit. I winnow it down. Okay, I recognize a little bit of the expense. I spread out the cost of that asset over the year. I do that by debiting insurance expense for $1,000 and crediting prepaid insurance for $1,000. Okay. Another way to think about it. So what I'm doing is I'm spreading out. I am matching that expense, that $1,000, to the time period in which that expense generated revenues, okay, on a month-by-month basis. Okay. Another way to think about it is depreciation expense on a piece of equipment. Actually, let me stop and point something out here. Everything you buy is going to get expensed somehow, some way, at some point. Whether it's a lathe on the machinery floor, a computer for use by the HR people, a desk used by the CEO, a delivery truck, office supplies, toner cartridges, printers, everything you buy will be expensed at some point, at some time, okay? Now, it's not always the full amount immediately, okay? Like, for example, what I'm saying is if I spent $10,000 on a printer, I'm not going to, probably not going to expense it. There is a concept involved here called materiality. We'll discuss that in a second. But what I'm getting at is you're probably not going to expense it all at once, okay? So let's think of it this way. It's January 1st, I go out and buy a delivery truck for $100,000. And I'm going to say it's got a useful life of 10 years and a salvage value of 0. So on January 1st, I write a check, okay, for $10,000. I debit an asset account called truck for, $100,000. I credit cash for $100,000. Okay. And then on December 31st, I have to spread out a portion of that $100,000. I take the $100,000 and I spread it out over the 10-year life of that asset, the useful life. That's called expensing. And particularly, it's called a depreciation expense. Okay, so on December 31st, and we're using the straight line depreciation method here. There are other ways to do it. You can use double declining balance, you can use makers, you can use units of production. We're going to keep it simple and just stick with straight line depreciation. So on December 31st, I'm going to debit an account called depreciation expense truck for $10,000, and I'm going to credit a contra asset account called accumulated depreciation truck for $10,000. Okay? Accumulated depreciation is a contra asset account. It's a normal credit carrying account. It is a permanent account. It shows up on the balance sheet. You do not close it at the end of the year. Okay? And the thing is, as time goes on, and as you depreciate every year, let's say in the 5th year, by the 5th year when I'm done with my depreciation process or entry, I should have a total accumulated depreciation of $50,000. That gives me a book value on the asset of the original asset cost of $100,000 less the accumulated depreciation of $50,000, which gives me a rough idea. The book value is $50,000. Now, does that mean that's what I would get if I put that out on the market? Maybe, maybe not. Maybe I'd get a little more. Probably I'd get a little bit less. You know, it's probably beat up, it's got dents in it, you know, maybe I've painted it some, I've got some, you know, company logos on it or something like that. But what I'm getting at is expensing, whether it's depreciation expense for property, plant, and equipment, amortization expense for intangibles like copyrights, patents, trademarks, or depletion of natural resources. These are all forms of expensing. where what I'm doing is I'm taking the cost of the asset and I'm spreading it out over the useful life of the asset. Okay. Full disclosure just says that I don't hide anything. Everything's either on the balance sheet or in the notes section of the financial statements. Now, there are certain assumptions that we operate under also when we are an accrual-based business. What is business entity? We assume that the business entity is separate from the owners. Okay? We assume, now we're not talking legal entity now, okay? But we're talking about the business entity is separate from the owner's activities, the owner's personal accounts. Okay? So you've got a checking account for the business. And your financial statements are focused on the business. You're not using your personal checking account for business purposes. You're not including, your own personal activities, financial activities in the financial statements of the business. It's a separate business entity. Another assumption is time period, where it says that we can break the business operations up over time periods, usually 1-year accounting periods, maybe quarters, maybe even months. Another assumption is going concern, where the assumption is we're going to continue to do business. And yet another assumption is monetary unit, which basically says that everything, all the values as expressed in the financial statements and when we do our journal entries, it's all expressed in some unit of currency, not donkeys, heads of cattle, barrels of beer, or hogs of tobacco. I think tobacco is sold in hogs. It's in some kind that all the values are expressed in terms of a currency. Now there are two other, I don't know if these are assumptions or principles. One is materiality, and the other is conservatism. Materiality really comes into play when you're talking about expensing. Okay. So let's say I'm Apple Corporation, and I go out and buy, on January 1st, I buy a brand new printer for $1,000. Now, Apple Corporation does billions of dollars in transactions every year. Am I really going to take the time to capitalize that asset? Capitalization is when you put the asset on the books. Am I really going to take the time to capitalize that asset and then depreciate it a little bit every year? Let's say, for example, that $1,000 printer has a useful life of 5 years. And I'm going to use straight line depreciation. Am I really going to depreciate that asset $200 a year? I kind of think the accountants have more important things to attend to. Okay? So the concept of materiality says, keeping the big picture in mind, if you're dealing with a sum that seems trivial, just go ahead and expense it. So Apple or whomever would probably just debit office supplies expense for $1,000 and credit cash or payable, however paid for $1,000. Okay, that's materiality. Conservatism says that if you're faced with two options, you choose the one that is less flattering or is less beneficial. So let's say I've got a situation where I can recognize a revenue as either $100 or $1,000. Conservatism says that I recognize the revenue at $100. On the other hand, if it's an expense, or maybe a payable, and the option is between $100 and $1,000, I recognize the liability or the expense at $1,000. Okay. So those are the concepts of materiality and conservatism.